Okay, this section is about scholarships and fellowships, and we already mentioned that scholarships and fellowships are normally not taxable as long as they are used to pay for tuition and fees and mandatory course related fees and books and supplies. Any part of your scholarship or fellowship that's not used for these purposes, even though the terms of the scholarship itself may say you can use this on room and board if you want to. If it's not used, if it is actually used on room and board and not tuition and fees, then it is taxable income. And again, you can elect to treat usually you can elect to treat part of your you can usually elect to treat part of your scholarships and fellowships as taxable in order to optimize your American Opportunity Credit. Scholarships and fellowships, if taxable, will go on to Schedule 1 down here, way at the bottom, line 8R. Now, the interesting thing about the rules on scholarships and fellowships and treating part of it as taxable is that for purposes of calculating the standard deduction for a dependent, taxable scholarships count as earned income. They don't count as earned income for any other purpose except for calculating the standard deduction. That means, remember, the standard deduction is equal to your earned income plus $400. So what that's going to mean is most of the time, even if you elect to treat part of the scholarship as taxable, or even if you have to treat part of the scholarship as taxable, very often your kids are not going to pay any taxes on it anyway. It's going to increase how much of the PFD turns out to be taxable. That's a small figure, just a couple $100. So when you're optimizing your American Opportunity Credit, you can usually just say, let's just take the maximum American Opportunity Credit that we possibly can. And even though it makes $8,000 the scholarship taxable, that goes on the kid's tax return because that's the kid's income. Just like Social Security, if it's in your kid's name, it belongs on your kid's tax return. PFD, if it's your kid's PFD, it goes on the kid's tax return. So since it goes on the kid's tax return, even if they do end up paying taxes on it, it's going to be taxed at a low rate, usually only about 10%. There are other types of educational assistance. Here's one. Veterans benefits that you receive for education or training are tax-free, and there is no option to treat them as taxable. So if you're going to school under the GI Bill, you have no education expenses, and you can't even opt to treat part of it as out-of-pocket education expenses for education credits. Let's see. Here's another one that's notable is IRA distributions. If you take money out of your IRA to pay for your own or a relative's education, then even though it's still taxable, it's not subject to the additional 10% tax that would normally apply to early distributions from retirement. And that person does not have to be your dependent. Education savings bond, this is rare. I haven't seen this yet in doing 15 years worth of taxes, so we'll skip that. Now we're going to talk about due diligence. Again, due diligence are heightened due diligence requirements applied to American Opportunity Credit, just like they did to earned income credit, head of household filing status, and child tax credit, and other dependent credit. One thing I should mention before we get too deep into this is that a lot of clients, a lot of taxpayers who just recently had their kids start college don't know about the 1098T, and the 1098T is issued in the student's name and social security number. So sometimes, quite often, we'll have to tell the parent to hunt down their kids and get them to log into their student portal to download the 1098T. So that's something we can do as added value is like if you see an 18-year-old or even a 17-year-old dependent on someone's return, you can ask, are they going to go to college? And if they do, you can say, well, you're going to get, might qualify for this $2,500 credit, but they're going to get a 1098T. It's not going to come to you. It's going to come to them. So make sure that they get it to you by next year when it's time to do taxes again. The 1098T deadline is the same as for W-2s and 1099, most other 1099s. January 31st it has to be issued. And most of the time it won't be mailed. It'll be available to them online. Okay, so we're required to exercise due diligence in all areas of tax preparation, not just these special areas. And that just means that we're going to apply common sense, make sure that the information that our clients are feeding us seems reasonable, accurate, and complete. And we can rely on our clients' statements unless they seem out of whack or unreasonable in some way. However, things like education credits, like we did mention, that you have to have the 1098T, so we can't just say I spent $10,000 on my kid's college. You actually have to have that form. And a lot of other times you have to have the form, like a W-2. You can't just say, oh, I worked and made $50,000 last year and had $8,000 withheld. No, you need the W-2. But if they're like in business for themselves and they have, if they have a printed out profit and loss, you don't have to go and verify every line item on their profit and loss and say, well, how did you come up with this $6,230 in supplies? Give me your printout of all your supplies or give me all of your receipts. Don't have to normally do that.
Only if there's an audit, right?
Yeah, only if there's an audit. Like you do have to let people know that this is the stuff you need in case of an audit. You should have this, handy. But you don't need to give it to me if you already know the numbers.
Just make sure the IRS you had it ready.
Mm-hmm. So most of due diligence for all areas of tax preparation is just the knowledge requirement. You have to apply your common sense. You have to be able to evaluate the information that they're giving you, make sure that there's no missing facts. If someone says maybe they're a housekeeper and they have no expenses, then you might have to identify why are there zero expenses. And that could be reasonable. It could be that the clients all provide all of the supplies. Or it could be that they say, well, I spend, I bring my own supplies, but I never keep the receipts. Well, then that's a missing fact. And now we have to actually try to, it's called reconstruct their expenses and come up with some reasonable estimate of how much they actually spent. You have to actually talk to, or it doesn't have to be like over the phone or in person. So it can be through text message or email, but you do have to communicate with the taxpayer every year. You can't just say, have them come in the door, drop off their stuff and leave, come in the door, sign the tax return and leave without even talking to them. So you do have to ask reasonable questions. And you have to understand the rules well enough to be able to apply the tax rules to the tax situation. So you don't need to know everything of what I just said today, but you do need to know that there's two tax credits. One is
American Opportunity Credit.
right, and the other one is So you just need to know that there's these two credits, and one's for undergraduates and one's for graduates. So you don't need to know all these details, but you do need to know that they exist. So if someone says, "My daughter's in college," is that even relevant for my taxes? You say, "Well, hell yeah, that's relevant." But when we're talking about American Opportunity Credit, here, head of household filing status, earned income credit, and child tax credit and its relatives, additional child tax credit, other dependent credit, we have extra due diligence requirements, which means we have to fill out a 8867, the due diligence checklist. We went over that line by line last week, so we won't need to do that again. But it's just basically to make sure you're doing your job correctly. Like, yes, I talked to the client. Yes, I believe that they qualify for this. No, nothing they told me seemed like a lie. And that kind of thing. So we do have these penalties, but again, I've never seen this penalty actually applied. It's never been applied against us or any of our preparers. And the rumor is that the IRS will send you a letter. It's called a soft touch letter. Say, here's some stuff you need to pay more attention to next tax season, instead of just saying, "All right, you failed, and here's your penalty." And again, we review all the tax returns, so don't be nervous about this penalty.
Okay, good, I'm glad you.
There was a couple times.
Because we want to make sure that you don't pay the penalty because it's applied to you and to the employer. So it is still best to do that up front, because like if we do catch a mistake, that usually means we have to call the client to come back in the office and at least sign it. So that's still a bad
It
look.
doesn't look very professional, yeah.
It's still a bad look. I mean, most clients would be like, okay, we have Eric or I would call the client and say, hey, look, we double check every tax return that's done by one of our newer preparers. And this case, we found something that they omitted, or we found it. We usually try to put it in a positive light, like we found some extra money for you.
There you go.
That makes it want to come into the office.
Yeah.
But sometimes it's like, well, your refund was more than it should have been. You should only get $3,000 instead of $4,000. And sometimes they don't want to come back for that. But yeah, don't be too concerned about the penalties. As long as you're making a sincere effort to do things right, then you're not going to suffer any penalties. And that's all due diligence really is that you're making a sincere effort to do the right thing. Okay, so quick summary. American Opportunity Credit is based on up to $4,000 in expenses. The credit is up to $2,500 per student. So if you have multiple students, you can get $2,500 for each of them. The American Opportunity Credit is basically for undergraduates. The Lifetime Learning Credit is for up to $10,000 of expenses. As 20% of those expenses, it's up to $2,000 per return, even if you have multiple students. And there's no limit to the number of years you can claim this credit. It's a non-refundable credit. You can't take more than one credit for the same student, but you can take multiple credits if you have multiple students. And the earnings from a 529 plan are not taxable if they're used properly. If they're not used on qualified education expenses, the earnings are taxable. Again, your principal is not taxable because you've already paid tax on that. And you can sometimes treat part of your scholarships as taxable, or part of your 529 or qualified tuition plan as taxable if you want to, in order to improve your education benefits.